If you ever built a financial model and got stuck trying to balance the balance sheet at the very end, you're not alone. That's where most people panic and go into fix-it mode, usually right before the deadline. But what if I told you there is a way to structure your model from the start so the balance sheet balances automatically, step by step, every single time? In this video, I'm going to show you the method I teach and use in every model I build. It's what I call the 3 hooks. All right, so here's the idea. The 3 financial statements are always talking to each other: balance sheet, cash flow, income statement. But if you don't set up those connections properly from the beginning, it becomes a nightmare to troubleshoot later. So I like to create what I call the 3 hooks right at the start of the model. It's a smart way to link the statements through structure and logic so that as you build each schedule, revenue, cost, capex, whatever, the balance sheet stays balanced. And if something goes wrong, you know exactly where to look. Let me show you how it works in Excel. We have a fully functional model here with the last few years actual, so we can project the next 5 years. I have already created the schedules you can see right here on the bottom. You see the operating schedule, you see the investing schedules, and you see the financing schedules. So you can open each one of them and explore as you wish. But right now, I'm not creating schedules. I have already done this before, so I can concentrate in helping you understanding how to link the results of those schedules in the 3 statements. By the way, this model, the way it is, fully functional, you can play with, and you can even change the numbers and make your own. It's right here down in the description, the link for you to download it. So download it, follow along, play with it, and understand how the 3 statements connect. So let's get started by creating the 3 hooks. That's the first thing I do. Usually, as I am beginning a model, even before I create the schedules, I just go back and create the 3 hooks. As I create each one of the schedules, I will have the 3 hooks in place and I'll know that my balance sheet balances. In this case, I already created the schedules. We're just going to link them in the 3 statements, but it's going to work the same way. So let's start by the income statement. I need the totals in place first. So the first thing I do is I'm going to pull the formulas, and if there's no formula on it, you have to create them. So I'm going to pull the formula for all the totals from the income statement. And I'll do the same for the cash flow. By the way, if you noticed, everything that is blue is hard-coded numbers. So I'm not pulling those because I know they're hard-coded. I'm just pulling the black cells because they're formulas. Whenever you are creating a financial model, make sure you use the blue cells to show what is hard-coded and what can be changed in your model without breaking the formulas. So now I'm going to pull the totals also for the balance sheet. And notice I am pulling only the totals. I'm not pulling any of the blue cells. Now grab this check right here on the bottom as well. So now I'm ready to create the 3 hooks. The first hook is going to be the net income going straight to my cash flow statement. So I'm going to link this right here. Just a simple link, nothing fancy. The second hook is my ending cash, which is being already calculated because I have the totals right here. My ending cash is going to go straight to my cash line in the balance sheet. And my third hook is going to be on my retained earnings. The retained earnings, the formula for the retained earnings is the previous year, the previous period, plus the net income, the accumulated net income, plus or minus the dividends. So I'm going to do the formula right here. I'm going to get the previous year plus my net income, and it should be minus, but because I'm linking directly to my cash flow, it's going to be plus as well, because in the cash flow, my dividends is negative. So I'm going to link right here. Now you can see I have a difference in my balance sheet, and that's because the balances are not calculated yet. Even if nothing happens in my model for the next few years, all the balance remain the same. So that's what I'm gonna do now. I'm going to create temporary formulas to keep my balances the same as my last period. So I'm just gonna copy this formula and paste it on every line except the ones that I already created. And to paste, I only want to paste the formula. I don't want to lose the format. I'm going to hit Alt ES and it's going to open the paste special. I can choose formulas and click OK. So now my three hooks are in place. Just to review them, the first one is my net income coming straight to my operating activities in the cash flow. The second one is my ending cash in the cash flow coming straight to my assets in the balance sheet. And the third one is my retained earnings, making the connection with both sides, bringing the net income and the dividends. So now that I have everything in place, let's start linking. I'm going to start with the revenue. And as I told you, I have already built all the schedules right here. So I'm going to open the operating schedule and I'm going to link this to my total revenue. Now that I have the revenue in place, you can see that it flows down through the income statement. It ends up on my cash because I received that revenue right away. I didn't set up any type of accounts receivable yet. So it's like I received everything in cash and it flows straight to my balance sheet. Once I have that straight on my balance sheet, at the same time, I am changing my retained earnings because of my net income. So it's actually changing my balance sheet in both sides of the equation, the assets and the equity. So I'm going to do the same with the cost. And it's going to be the same effect. So I'm not even go through, but you see that it's going to happen the same here. For my SG&A, I am going to grab, let me just open my assumptions right here because I need the inflation to link. I'm going to grab the last period and I'm going to apply 1 plus inflation right here. Now I have linked everything from revenue and cost. Let's take care of the working capital. The working capital is all the current assets minus the current liabilities in the balance sheet. However, I don't use the revolving credit as a current liability for the working capital, even though it is a current liability. I'm going to use this separately. So for now, I am going to project only the accounts receivable, inventory, and accounts payable. Of course, if you have a more complex structure of working capital, there might be other accounts there. So consider for working capital all the current assets minus the current liabilities. I already calculated them right here on my operating schedule. So I already used days of accounts receivable, days of inventory, days of accounts payable, GSO, GIO, as you wish to call. And I use the average of the last few years to project them in the future 5 years. So I did plainly this. You can do whatever you want as an assumption. I just used the average. So I'm going to link them straight here on the accounts receivable. On the inventory. And now I can copy this to the side. And you see I already have a difference right here, but we're going to take care of this right away. And accounts payable. Once I have that, I have a difference right here on my balance sheet, and I am going to take care of this by adjusting my cash. Once I say that I have accounts receivable, it means that I am delaying the cash I am receiving. So remember when I added the revenue right away and it flowed through straight to my cash? What I'm saying with the accounts receivable, by increasing the amount in my accounts receivable, I am saying that I am not receiving all of that revenue right away in the same period. I am leaving some of that revenue for later. The same with my costs. I am not paying everything on the same period. I am leaving to pay some of that later. So whatever remains in my working capital, whatever remains in my current assets or current liabilities, I need to adjust in the cash. So that's why I'm going to link this right here to the changes in working capital that I calculated right here. And with that, I am balanced again. So now I have done all the operating schedule. I am ready to go on the investing schedule. So the investing schedule is the PP&E, property, plants, and equipment. This is the line of the fixed assets. This is where I calculate the fixed assets. So you'll see here on my schedule that I first calculated the balance of that account in the balance sheet, and I also calculated the depreciation. And to calculate the balance of the balance sheet, I use two items as well. I use the CapEx. I increase the balance with the CapEx, and I decrease it with the depreciation. So those are the items that we are going to link in the income statement, balance sheet, and cash flow. So let's start with the line, the main line, the net PP&E. Once I link that, I have a difference again in my balance sheet. So now I'm going to go to the CapEx, which is in the cash flow, and it's going to be a disbursement. It's going to be a cash disbursement, a cash outflow. I'm going to pay for the equipment that I'm buying. So money is going out of my bank account. So I'm going to link this negative down to my CapEx. And of course, I still have a difference because the last piece that is missing is my depreciation. So the depreciation is considered as an expense and it goes straight to my income statement. But in this case, my income statement is taking it as positive. It's already considering on the calculation here, it's already subtracting it from the EBITDA, so to get to the EBIT. So I am going to link this as a positive number right here. So make sure you don't make that mistake. And I have it right here. Now, when I do that, I am reducing my net income, and the net income is used in my cash flow. However, depreciation is not a cash transaction, so it shouldn't affect cash in this way. What we are going to do, we are going to put it back. So that's why we add the depreciation back right here in the cash flow. So when you see how depreciation impacts the three statements, it impacts the three statements through the PP&E line on the assets, because it is reducing my PP&E every year, and at the same time it's being expensed, so it's reducing my retained earnings. The net income is reduced and it's coming here reduced, but it shouldn't have an impact on the cash flow. So now I have that with the investing schedules as well. I have balanced my balance sheet. So now the last one is the financial schedules. I'm gonna close the investing, I don't need it anymore for now, and I'm gonna open the financial schedules. I have here two schedules. I have the equity schedule and I have the debt schedule. Let's just start with the equity schedule. I should have calculated the balance in my common share line. It doesn't change because I didn't issue shares, I didn't make any purchase of shares, so my common share line remained the same. So I'm just going to link here just for the sake of having it correct and dynamic, because if I ever change this, I'd like to have it linked on the right place. So I'm going to link this right here. And the other side is the dividends. So when I pay dividends, it's going to affect the cash flow and also affects the retained earnings. So those are the two sides of the equation that the dividends affect. But it goes in right here, and I will link it, but I want it negative. So because I am paying the dividends, it should be negative on my cash flow. So I'm gonna link it right here, common share dividends. And once I do that, my balance sheet is balanced as well. I don't have many other pieces of equity to put it on. I just have the common shares, but I always do a retained earnings schedule just to make it more clear what is going on inside. So I have it here. It shouldn't change anything. As you can see, the number is the same, but I like to link it back to my schedule. So just for sanity, I am going to keep it linked to my schedule. And for the shareholders' equity, if there was anything going on, usually this is something that is pretty stable. It starts with an initial capital and then it keeps like that forever until the partners or the owners have any type of distributions. Then if you want to show that, you will do the same as you did in the common shares. And make sure you also do the same treatment for the distributions as you did with the dividends. But right now, I don't have anything, so I'll just keep the same balance. Now the debt. That's the most fun one. So let's get into it. The first one that I'm going to see is the revolving debt. The revolving debt is one that covers for any gap you have in your cash. And this is already set up the way it is, bringing all the items from the cash flow so I can calculate my free cash flow for the year. And you can see right here that I have free cash flow for the first 3 years. And then I began to have a gap in my cash. So that's when my formula is borrowing down some money to cover for that gap. And that's when I have to pay interest. So I am going to link this. You are welcome to explore these formulas, and I might be shooting some videos about this in the future. But for now, I'm just going to link this. This is pretty complex, but it's how the model becomes dynamic. And this model is fully dynamic. So I will start by linking the ending balance of my revolving credit to the balance sheet. So it's right here. I will link it right here. Ending balance. And you see that it already shows a difference right here, and that's because I'm missing the cash flow part. So whatever I borrow or whatever I issued of debt or whatever I repaid of debt needs to go in the cash flow. So I'm going to link this right here, and it already is with the right signal, so I don't have to worry about that. Right here. So you see that when I borrow money, money gets in my account. And when I repay, it's going to get out. So in this case, it's just getting in. And my balance sheet is balanced. I still have one other piece for the revolving, which is the interest. But I'm going to add them together at the end and link just one time, because I can sum them together and it goes to only one line in the income statement. So let's do the last piece of debt that I have here, which is the fixed term. It's a long-term debt. So I have calculated here the same way. I calculated the balance in the balance sheet by just getting the previous year's balance and adding or subtracting any issuance or repayment. And then I end up with my final balance, with my ending balance. And based on that, I calculate the interest. So I'm going to link this right here to my long-term debt. And it doesn't matter how many pieces of debt you have to make a schedule for each one of them because they have different characteristics. And now I am going to put on the whatever on the cash flow. I'm going to put whatever I paid or issued of this debt, which is this right here. Now you can see my balance sheet is balanced, but there's one piece missing. It's the interest that I need to link there on my income statement. And the reason it doesn't unbalance my balance sheet is because everything in the income statement is affecting cash and is affecting equity at the same time. Okay, so we have everything linked. You're welcome to play with this and make changes and break it and fix it as much as you want, so you actually learn how to link those schedules in the 3 statements. This is a very important thing to do as you are building a financial model from scratch. Now that you've seen it in action, you can start every model with the 3 hooks in place. You never need to fix an out of balance model from scratch again, because your structure will catch it for you. I know it might feel a lot to cover in one video, but if you're ready to go deeper, you can check out my full course where I build a financial model from the ground up, step by step, always keeping the hooks in place and always showing the explanation for the financial concepts. You'll find the link for the course in the description below. Also, if you have questions, put on in the comments. I'm here to help. Hit like and subscribe. It means the world to me to know that you guys are taking a lot of advantage of those videos. I'll see you in the next one.